I'm Gordo, and we're going to go look at charts that represent the economy in the background that isn't usually covered media wise. And I will show you predictions too about gold and silver today. So, first, we have the Bank of England cuts key interest rate from 4% to 3.75%. Why would they do this? They try to do this to try to lower borrowing rates to increase spending, essentially. You also have how gold's safe haven appeal is fueling record prices. In my last videos, I talked about what's currently happening in the banking system. Currently, if you guys are new, the banking system is all locked up. People are not borrowing from each other. People, as in banks. Banks are not borrowing from each other, which is causing a lack of liquidity, which is just money flow around. And now banks have to go find something to help back them up. Thing is, when you go for gold, it doesn't work well in a debt based system because gold is not money in a debt based system. The central bank gold purchases. This one is slightly outdated, but it does show increases in gold buying for the past few years. This is important because keep in mind the banks are struggling right now. You also have 2026 global economic outlook growth slows amid supply shocks. So, when you don't have money flowing around like we currently don't, it's going to affect the economy more in a bad way, as inflation will probably go up and spending will be down, which sounds weird, but that is how economies break. You also have the Fed to inject 6.8 billion into markets in first repo since 2020. Why crypto is paying attention. So, you guys have the Fed. You guys already know the Fed doesn't really print the money. It's the US Treasury. The US Treasury prints the money. This is a review, by the way. The US Treasury prints the money. The big bank, Chase, buys the T-bills. And only then the Fed can buy the T-bills from the banks. And that is how the Fed can actually print money, is to only pay back Chase and add numbers to their account. It's not money, it's just numbers on a sheet of paper. Liabilities and capital. When this chart goes down, that means the Fed has less money in the accounts for banks. So this is like the bank's backup plan because the Fed only creates reserves. And if the reserves are going down, well, banks need somewhere to go to be able to back up their loans that they have. Because remember, T-bills are just debt. So they go buy gold, which is an asset, not money. Also, the overnight reuse purchase agreements. So this one, when it goes down, as shown here, this means the Fed is draining less cash from the global markets, which means it's trying to keep it full to try to keep liquidity up. Because if you keep liquidity up, you have a healthy economy. Right now, we don't have a healthy economy, and the Fed's trying to keep the economy full of money. So it doesn't work well. It also causes a crash. So we'll go into gold and silver real quick. So for those of you that don't know or do know, I do map out charts. I do give you said predictions, and they don't always hit the price targets. I'm just correct most of the time for some reason. So here's your gold. I said you break out of this pattern here. This yellow line, here's your 200-day moving average. You have support to the upside. So right now that 200-day moving average is pushing up on the chart, making the price want to go higher. We broke out of this pattern, which means we go up. And I said the measured move is up here to 411, 412. And you guys can see we jumped up today, so somebody's having a fun day buying gold. Now to follow up, I'll show silver. This is silver. You have your pattern, you broke, you have your 200-day moving average pushing you up, but you guys went past my predicted target. I said you would only go to $82.04. You guys went past it. You are now at 88.6 cents. If you guys were to take out a trade, it was a paper trade because we don't use real money. But if we take this measured move, we'll go from the bottom to the top, where I would say to get out. About 20% you're up. So that'd be to retirement account, your Roth IRA, whatever. 20% is a lot. Finally, just to show you, because the Fed expects not to cut rates, this one is not about rates. This one's more about inflation, because they said you have more money out there, but the Fed has less money in its reserves right now, and banks are going for gold. So here, you're going to want to hope I'm wrong on this one, but it broke out of this pattern that usually goes up. If you clear that 200-day moving average, it's all over. This one is your 10-year yield. It just shows inflation. So when it goes up, inflation. When it goes down, deflation. Right now, we are set to go up, which is not good for anybody because you guys already know how expensive eggs are compared to chickens. It's very horrible. And seems like we found support here on the neckline again. We've hit it like, what, 3 times now? Yeah, you're going to want that to break. But we haven't yet, so it's still most likely going to go up. For those of you that followed last week's videos, this is the next part. So I said you can go ahead and buy a T-bill to try and beat your savings account, which was like at most 0.63%, and a T-bill was at the time of recording that video 3.63%. So a lot more percents. But the final thing that I would tell you to do to try to gain as much money in this debt-based system and move your money around and keep it safe, remember, not financial advice because I'm just a fictional character, would be just to trade these charts. So let's jump back over to gold real quick. So here's your gold. Now with the trading, it's different from investing. Investing, you buy and hold, and for some reason you guys don't take profit. In trading, you buy low, you sell high. Or you know how to short stuff where you sell high, make money on the way down, and then buy to close the position. So here, if you would have bought gold back over here when it broke a pattern over here, you would be up. Let's see. We'll just measure from this breakout to where it topped off. You would have been able to get out of by here. You would have known to get out. So that's what? 19%? You take that money and you run. It's just a little grab. You're not buying and holding. Or for you guys that like just buying but on bigger time frames, you can go to the weekly or the monthly. We'll go to the monthly. So here's your monthly. This is a pattern here. It took forever to form, but this is called a cup and handle. Let me draw it out for you. There's your cup. And then over here, you have your handle. I'm just going to draw it roughly. It's also having a inverted head and shoulders inside of it, which means inverted means it wants to go up. So we'll just draw that. Boom, done. You guys would have measured from there to the bottom of the cup and then go up, and you would have just ridden that all the way up. But if you took profit at the price target, you would have been up. You would get in there, and then you get out here. You would have gotten your 36%. And if you let it keep running, it would be at, let's see, 99% up. And you would have bought back in January 2024. So there you go. So that is the final part of moving your money around. So I will see you guys Wednesday, and we will keep talking more about breaking down charts. And please make sure if you like this content to like and subscribe and share the video if you found this helpful.